studying your last two. I swim med when turned in. The staring down to mute. And can learn the pole that sunk he died.
In this slide, we'll introduce Schedule 6, which is used to report the disposition of capital property by a corporation. The word disposition simply means that the corporation no longer owns a capital asset. In most cases, this happens because the asset is sold, but a disposition can also occur when an asset is gifted, exchanged, transferred, or even expropriated by a government authority. Whenever a corporation disposes of capital property, Schedule 6 is used to determine the tax consequences of that transaction. But what exactly is capital property? Capital property includes assets that are acquired to provide long-term value to the business, rather than being sold as part of its regular operations. Common examples include commercial buildings, shares of other corporations, business land, rental properties, and vacant land held as investments. These assets are different from inventory. Inventory is purchased for resale as part of the corporation's normal business activities, while capital property is generally acquired to generate long-term income or appreciate in value over time. The flowchart in the center illustrates the basic process. The corporation first owns a capital asset. At some point, that asset is disposed of, usually by selling it. The details of the transaction are then reported on Schedule 6, where the corporation determines whether it has realized a capital gain or a capital loss. The timeline at the bottom summarizes when Schedule 6 becomes relevant. First, the corporation purchases a capital asset. It owns and uses the asset for a period of time. When the asset is eventually sold or otherwise disposed of, Schedule 6 is completed to calculate the resulting capital gain or capital loss for tax purposes. The important point to remember is that Schedule 6 is only required when there is a disposition of capital property. Simply owning a building, land, or shares does not require Schedule 6. It becomes necessary only when ownership changes and the corporation needs to determine the tax consequences of that transaction. A simple memory trick is this: if a corporation disposes of capital property, think Schedule 6. Now that we know when Schedule 6 is used, let's learn how it calculates a capital gain or a capital loss. Whenever a corporation sells a capital asset, Schedule 6 compares three important amounts. The first is the proceeds of disposition, or simply the selling price. This is the amount the corporation receives when the asset is sold. The second amount is the adjusted cost base, commonly called the ACB. The ACB generally represents the corporation's cost of acquiring the asset, along with certain adjustments that may have occurred over time. The third amount is the selling cost. These include expenses directly related to the sale, such as legal fees, commissions, brokerage fees, or other costs incurred to complete the transaction. Schedule 6 uses a simple formula to calculate the result. It starts with the selling price, subtracts the adjusted cost base, and then subtracts the selling costs. The remaining amount is either a capital gain or a capital loss. Let's look at the example shown on the slide. Suppose a corporation sells a commercial building for $500,000. The building has an adjusted cost base of $420,000, and the corporation pays $10,000 in legal fees to complete the sale. Using the formula, we subtract the adjusted cost base and the selling costs from the selling price. $500,000 minus $420,000 minus $10,000 results in a capital gain of $70,000. If the selling price is higher than the adjusted cost base after deducting selling costs, the corporation has a capital gain. If the selling price is lower, the corporation has a capital loss. However, An important tax rule applies here. The entire capital gain is not included in taxable income. Instead, only the taxable capital gain is included. Under the current Canadian tax rules, only 50% of a capital gain is taxable. In our example, the corporation realizes a capital gain of $70,000. Only 50% of that amount, or $35,000, is included in taxable income and becomes part of the corporation's tax calculation. The key point to remember is that Schedule 6 calculates the capital gain or loss, but only the taxable portion of a capital gain is ultimately included in the corporation's taxable income. In this final slide, let's see how Schedule 6 fits into the overall T2 corporate tax return. The process begins when a corporation sells a capital asset, such as a building, land, or shares. The sale is first recorded in the corporation's financial statements, where an accounting gain or loss is recognized according to accounting standards. However, accounting rules and tax rules are not always the same. That's why the next step is Schedule 1. Schedule 1 adjusts the accounting income to arrive at the correct income for tax purposes by adding back non-deductible expenses, deducting allowable tax adjustments, and making other required modifications. Once those adjustments have been made, Schedule 6 calculates the actual capital gain or capital loss for tax purposes. It uses the proceeds of disposition, the adjusted cost base, and the selling costs to determine the gain or loss resulting from the sale of the capital property. If the corporation has a capital gain, only the taxable portion of that gain moves forward in the tax return. The taxable capital gain then becomes part of the corporation's investment income calculations, which are reflected in Schedule 7 before flowing into the T2 corporate tax return. This means that Schedule 6 is not an isolated schedule. It forms an important link between the corporation's accounting records, the tax adjustments made in Schedule 1, the investment income calculations in Schedule 7, and finally the corporation's T2 tax return. The comparison on the left also highlights an important concept. The accounting gain shown in the financial statements may differ from the taxable capital gain reported for tax purposes, because accounting rules and tax legislation often use different measurement methods and adjustment rules. The panel on the right shows some common mistakes to avoid. These include using the wrong adjusted cost base, forgetting to deduct selling costs such as legal or brokerage fees, overlooking capital losses, reporting inventory instead of capital property, or forgetting to complete Schedule 6 when a disposition occurs. Any of these mistakes can result in an incorrect capital gain calculation and an inaccurate T2 return. The checklist at the bottom summarizes the entire process. Record the proceeds of disposition. Determine the adjusted cost base. Identify the selling costs. Calculate the capital gain or capital loss. Determine the taxable capital gain. Transfer the appropriate amount to Schedule 7. And finally include it in the T2 corporate tax return. The key takeaway is this: Schedule 6 does not decide whether a corporation should sell an asset. Its purpose is to calculate the tax consequences after the asset has been disposed of, ensuring that the correct taxable capital gain or capital loss is reported on the corporation's tax return.